Well, welcome everybody. This is a video that's been put together to introduce a tool that's currently being worked on called the Global Credit Risk Monitoring and Management Tool. Just some background information on it from a software design point of view. What's the purpose of the software? Well, that is to quantify the current performance, whether that be of individual companies, industries, countries or regions of the world, and to understand not only their performance but the risk associated with those segments. It allows you to go in and do some scenario testing, stress testing on constructed portfolios, so that we can then put those portfolio performances into context from a point of view of performance and risk. Having assessed each portfolio, we then need to determine how much economic capital we need to allocate to take on those potential risks, and there's different studies within the program that allow you to do that. And then, having gone ahead and done our modelling and understand our capital that we need to allocate to accommodate those risks, obviously there's a need to continue to monitor ongoing performance, you might say, and understand the factors which are impacting the future potential performance on those portfolios. There's also mechanisms within the software to allow people to report up the line, which is becoming increasingly important. The formatting of reporting of information as it's being communicated to credit departments or senior credit committees, and also external reporting bodies, whether they be government or associations. The software, as indicated before, is very much about a top-down, but it also can be a bottom-up approach to analysis. It looks at, from the top down, it looks at the various regions of the world, and from within regions we can break down risk by countries, then in turn industries, sub-industries, and all the way down to companies. The software also is capable of doing sovereign risk and also counterparty risk as well. When we're talking about stress testing, what are we doing? Well, we're really looking at all the potential factors which impact performance, whether they be at regional level or country or company or industry levels. We are talking about interest rates, currencies and metals, energies and foods, of course, normal economic measures of performance, growth of domestic product and alike, geopolitical measures, stability of individual countries or regions of the world, environmental risk, and also there is an ability to add in other factors and to measure their potential implications for portfolio performance. As I mentioned before, it goes through and does a lot of economic capital modelling. We'll have a look at some of the menus there. Value at risk, obviously, economic cost of risk. It also allows people to assess their risk appetite, or to measure the potential risk appetite they're willing to take on, and then to run a series of simulations so that they fully understand the distribution of potential risk and the percentage of risk they're willing to take on. As indicated before, we're talking about these macroeconomic drivers and the ability to alert changes in circumstances through and to be able to measure their potential changes or implications for portfolio performance. One of the key factors of the software is that it brings to the table, you might say, more information on behavioural changes in capital markets. It's not only looking at historical, traditional measures of economic performance, such as GDP and the like, but it's also looking at how the larger institutions are positioning themselves in various commodities and currencies, so that we can understand what side of the market the large players are on and what their prevailing bias is, and you might say through that we can then understand what the general traders, you might say, in the world are positioned in the market, or the the hedge funds and what have not, so that we understand whether the larger end or the institutions are actually accumulating or distributing various commodities, currencies or equities. As we said before, it also performs that important function of being able to distribute concise reports up the line to line management. In some instances they may choose to plug into the information themselves to do their own studies, obviously credit committees and alike, and as we said before, national regulators and regional reporting bodies. So without any further ado, let's take a look at the software itself. This is it in prototype mode. As you can see, it's a fairly standard Windows presentation. And as we mentioned before, it very much works or has the ability to work top down, but also, as I mentioned before, having gone top down, we can then go bottom up as well from an analysis point of view. Here we can see the ability to isolate various layers in the world, you might say, either at a regional level or country levels or industry or sub-industry and down to company levels. Now we might take a look at the world as broken up into various regions of the world, and here we can see the regions on the left, and across the top here we can see a series of column headings relating to, once again, performance in terms of growth, and then in terms of risk. And you'll notice there that the software will break down the various firms within the regions into different categories, given that most often size does also relate to risk, and it breaks them up into three groups: large tier firms, mid-tier firms and small firms. As we drill into the software here, we can then go to the next level, which is looking at countries within a region, and once again you'll see it subsets those countries within that region into the primary three measures, whether that be high growth, medium growth or low growth, and from a risk point of view, high risk, medium risk and low risk. Just down the bottom here you'll see the various inputs, economic sensitivities. These are just broad categories, you might say, of interest rates, and they are interest rates from all over the world, currencies, metals, energies, foods, as we mentioned before, the key economic measures, the geopolitical measures as well, how stable the various governments of the world are, any areas which might be exposed to environmental risk as well. So what we can then do is drill into the software and look at the database in effect and see what various data series it presents to us to work with. Here we're looking at interest rates, and this is just an example of US bonds and UK bonds, and so it's very much bond focused here. And you can see over here, because in effect what we propose to do is run a simulation, in other words go back in time and then walk forward to see first of all what normal performance or actual performance looked like, and then come in and customize for different types of parameters, whether we increase or decrease various parameters, and then do our walk backwards test again with that adjustment factor built into the testing environment. So we'll just pack this up, and so that's a regional level analysis, and from regions, of course, we mentioned before, we can drill into lower levels of analysis. Here we might focus, for example, on country analysis, and it's not dissimilar in design to the regional layer, where we have in effect all the countries of the world down the left, and we have our economic sensitivities down the bottom, and once again our performance matrix again, once again looking at overall growth and measuring growth, and also risk amongst firms within these different countries. If we go into Australia here, we can now see it drops down to the next level, which is the industry level, and you can see also here it's followed our basic doctrine of low, medium and high matrix, and we can then see how each of those industries are performing. There's two ways to run the software. One is using industries as benchmarked against other country industries, in other words, arriving at a understanding of performance globally per industry, or it can be segmented and just simply run of comparing performance relative to other industries within an individual country. Similar to the other layer, once we've determined which countries we want to include in our analysis, we can then come in and go in and dial in effectively the parameters we wish to modify from history to see what the implications would have been for history, and then we can understand what the potential risks were and perhaps get some insights into what those risks might be going forward as well. So let's drill down now. So we've been from a regional level down into a country level. We're now looking at that industry analysis here, where we can compare once again the one industry to another or collective group of industries, or we can use the within country parameter to in effect isolate the comparison to just one single country. You'll see here once we click on the industry group aerospace and defence, we are now drilling down to what we call the sub-industry level, so that we're getting more closer to the underlying sub-industries themselves, and just following the governing matrix of low, medium, high measures of performance. Once again, our sensitivities are down here, and we can simply dial these up and input those to assess what the overall performance looks like. As we drill into sub-industry levels, once again we have all these listed following the usual matrix of presenting all the different firms within these sub-industries. And this time, as we click on a sub-industry, we can now for the first time see individual company measurements of performance, and also their associated levels of size and also risk. Here once again we can do our economic sensitivity testing, once again change the parameters as we see fit, and then go in and run our simulation. The software also has provision for sovereign risk analysis. Here once again you have all the different central banks all listed, working on the same criteria. What are the potential implications on all these central banks, and once again performance ranked, this time using different matrix, political score, economic score and a fiscal score. These parameters are customizable, and users can select more specific conditions if they like as part of the program. Here we're now looking at counterparty risk analysis, perhaps sometimes referred to as just bank-to-bank risk, and as you can see all the banks, or at least a sample of banks, is listed down the left hand side. Here we can see once again the performance matrix is out on the side, a lot of assessment done by either growth of obviously the individual bank, market implied market ratings, external ratings agencies and liquidity assessments. Key point here being once again these criteria are selectable, and so users are free to add or vary those to suit the specific analysis they're undertaking. We mentioned before, once we've done our scenario testing, stress testing, we need to do economic capital modelling. Here we can see a range of potential models: value at risk, risk of ruin, examples such as extreme value theory, where in effect we select the economic capital modelling we want to run with, and then simply drill into and use the functions of the software to complete that exercise. Here we might look at some cash flow analysis of a layer, for example, just to understand what the potential forward implications are for a particular portfolio. In this case, what we'll use as our sample is sub-industry level analysis, where we have the groupings of all the different companies within the industries down the left-hand side, and then broken up in our normal matrix of their overall performance and break up into firms. This works the same way as all the other layers with our economic modelling downstairs. If we go up here, we can then come into and decide what is the constituent list we want to benchmark performance against. So basically what it does is carries over the list that we have prepared. Now we might want to, for example, filter that list. We may want to also restrict the type of benchmarking analysis. Do we want these industries to represent, a region of the world, a country, or globally? And we can also filter by market capitalization to remove companies within those sample groups or constituent lists that may be too small or too large, for example, depending on the portfolio we're testing. If we use the filter functions here, removing any firms that are sub 600 million, the list then gets refined down to a significantly less number, and in this instance we will use the country comparison. So this might just be an individual portfolio within a specific country. Then what we do is we take that portfolio. In this case we might be looking at, say, a residential portfolio, retail property, and understanding the servicing side of the analysis, looking at where the capacity to pay is coming from and what that industry exposure is to that portfolio, and as time goes on, what's the potential implications for some industries. For example, motor vehicle manufacturing industries are perhaps somewhat on the wane, and 3D printing type firms and industries are perhaps growth prospects for the future. So understanding the area in which the servicing is dependent, and then being able to put against that the percentage of exposure of this retail property that is dependent on these industries for servicing. Our next step is to go in and to be able to set up our simulation. You'll notice here that we have commencement dates and end dates, and how fast we want to walk forward, and whether we want performance charts displayed and built as we're going along. Also, we want to be able to display additional information so that once we've actually run the simulation, we can go back in time and see how some of the key performance measures looked at different points, and whether or not measuring those as potential risks assists in understanding the portfolio risk going forward. So next we input information relative to the simulation that we want to run. This one here is going back to 1990. It will run through till the end of December 2002, and it has a walk forward rate based on calendar quarter intervals. Once we've put all this information in, we're then ready to run a portfolio simulation, and here you can see the residential portfolio has been created, and once we press run on the software, it would go ahead and complete the simulation and then re-rank this portfolio relative to the overall industries that is being benchmarked against. Just a few words quickly on Having run simulations and understanding the portfolio risks, obviously we may want to set portfolio alerts so that, you know, as users log on and the software is updated, it will then flag any of the risks that have been highlighted through the simulation period to be presented to the users as in a formal report as they come online. As mentioned before, there is a series of other reports. At this stage they're flexible in their design, but looking to cover management reporting levels and, as we said, credit exec levels, and also national regulators and other reporting bodies, whether they be regional or otherwise. Well, that's it for a quick overview of the software. Please feel free to ask us any questions, and we'd be happy to answer them. Thank you.